In today's episode, I'm going to walk you through how an equity swap works. Now, equity swaps have been a popular topic of conversation as of late because of the heightened volatility in meme stocks like AMC and GameStop. One of the things that's really unique about an equity swap is that it can allow a hedge fund or an institutional trader to take a very large position, whether long or short, without actually having to purchase the securities to back that position, which is kind of wild when you think about it. So as I walk you through how these work, you're going to learn that equity swaps are a very powerful vehicle in the financial markets that can allow hedge funds and institutional traders to make a tremendous amount of money, but they also carry a lot of risk. Now, these equity swaps allow the purchase or shorting of stocks without direct ownership. They do not require or subject the hedge fund or institutional trader to the regulatory requirements that direct ownership would require. The positions, if they're to the short side, do not increase short interest on the stock, and there's no market movement from the purchase of these swaps. An equity swap is actually, it's like a side market bet between an investment banker and a hedge fund or institutional trader. And that side market bet, it's a OTC contract. It doesn't actually move the underlying price of the asset. So essentially, you could have a stock that's trading with 10, 20 million shares of volume a day, and then you could have a side bet on the performance of that stock that is many times larger than the entire volume of that stock on that particular day, which is what's crazy about these swaps. So let's go ahead and jump into the slide deck so you can better understand how these work. And I think what you're going to discover is that by the end of this episode, there are certain types of stocks that retail traders like you and I should probably just completely avoid, and equity swaps are just one of the reasons. So equity swaps, by the way, are just one type of swap that exists. The swaps have been around for a long time and they're very common. Interest rate swaps are very popular. Currency swaps are very popular. Commodity swaps, credit default swaps, and of course, equity swaps, as we're going to talk today. They all share the same sort of general concept of a trade between one thing and another, between an investment bank and an institutional trader or a hedge fund. So when it comes to equity swaps, an equity swap is an exchange of cash flow between two parties. These two parties are typically a hedge fund and an investment bank. In a swap, a hedge fund can go to an investment bank and purchase what's called a synthetic long or a synthetic short equity position. This is done through the equity swap. So you have these two parties, the investment banker in yellow and the hedge fund here in blue. Now, equity swaps are derivatives, which means the price and value of the equity swap and the cash that changes hands between party one and party two is based on the value or the price of an underlying asset, which in this example that I'm going to give you is the stock, which we'll use GameStop as the example. So when you buy positions in derivatives, buying the derivatives by themselves do not have an impact on the price of the market, of the price it's actually trading. So if we pull up a stock, let's say right here, like GameStop, if you actually bought 1 million shares of GameStop on the open market, what do you think would happen? The volume would spike up. You would see a huge order going through on the time and sales. It would go through the level 2. There'd be a volume bar. There'd be a giant green candle, right? That's what happens when you buy a really big position on the open market. But in the derivative market, it's a little bit different. With the derivative market, when you purchase these equity swaps and you get into this equity swap contract, it's completely aside from the market. So the total value of that swap, it could be $100 million, it could be $500 million, whatever it is, that's not going through the time and sales for the stock. So these transactions can create market volatility, but they create market volatility when and if one of the parties purchases stock on the open market to hedge their position. But it's only if they're hedging their position that you're going to see actual changes in market prices. The contract by itself of an equity swap does not move the market. So that's important to know when it comes to GameStop. So derivatives are an alternative to direct ownership. So with an equity swap, for instance, it requires less capital because you do not have to buy or short the underlying stock. So let's just say, for instance, just for the sake of argument, that you want to short or buy a stock. We'll just say you want to short GameStop here at $20 a share. You want to short at $20 a share. It doesn't matter the price. You want to short 1,000 shares. 1,000 shares. Well, that's $20,000, right? 20 grand. That's no big deal to get, $20,000 position on the market. You want to short 100,000 shares? Okay, that's a little bit of a bigger order. You want to short 1 million shares? Okay, now you're talking about a position size that would move the market. And if you don't want to move the market with your position size, you could choose to take that same trade, but not take it on the open market. Take it through an equity swap. And this is why these are so fascinating. So now it's worth noting that that these equity swaps do have to be reported to DTCC, which is where all trades are cleared. But finding the details about the individual swap agreements is difficult. And most traders and even research analysts, security analysts, have a hard time finding all the details of these swaps. So it's convoluted, they're hard to find, and as a result, the market doesn't accurately price the extent to which swaps exist in favor or against a stock. So for the sake of argument, let's just say that a hedge fund wants to short $100 million of GameStop at $20 a share. So they want to short, 5 million shares. All right, so 5 million shares to the short side of GME at $20. All right, now they know if they tried to short 5 million shares on the open market, what would happen to the price? It would drop the price. Now, today, for instance, GameStop has 12 million shares of volume. So if you wanted to short 5 million shares, you would be half the volume of GameStop for this entire day. If you subjected the stock to that much selling, it would drop it. And then the result is that instead of shorting at $20 a share, by the time, you've taken your full position, the prices maybe drop to, let's just say, $15 a share. So now you're getting it at a substantially lower price, $25 million worse of a fill, versus if you instead did an equity swap. So let's say you are sitting there at the hedge fund and the fund has $100 million and it says, hey, we want to short GameStop. All right, so they don't want to short on the open market, maybe because of the market, the risk of moving the market with that big of an order, maybe because of the short interest or the requirement to do disclosures if it's a very large position. So they instead go to the investment banker, and the banker agrees to write a swap agreement. So the hedge fund in blue goes to the investment banker in yellow. Now, investment bankers will customize these swap agreements to suit the fund, the hedge fund, the institutional trader that's coming to them. They're very customizable. They have a standard format, but they can be customized based on what the fund is looking for. And the investment bankers, they want the business, right? They want to make the business because they're going to make money on this deal. And you're going to learn how that's going to work in just a second. So this is an example of an equity swap and the terms for what would be called a synthetic short. It's called a synthetic position because you essentially pay profit and loss as if it's a real position, but it's not a real position. So it's synthetic. Okay, so the underlying asset in this case is GameStop short position. The notional amount, which is the amount of money that you're putting in the position, is $100 million. So you're putting in $100 million. In this case, it's at $20 a share, which is 5 million shares. Now, this is going to be a total return swap. So if you had a swap that did not include dividends, then it's a price return equity swap if it doesn't include the dividends. But if it includes the dividends, then it would be a total return equity swap. Now, GameStop doesn't pay a dividend, so in this case, it doesn't really matter. But the way this term sheet works is that you've got the asset, you've got the notional amount, you've got the terms here. So this is a total return equity, which means the hedge fund is going to earn the profit or pay out the loss on this position. And in exchange for this swap, they have to pay the investment bank the benchmark interest rate, which let's just say it's about 5% right now, plus 1%. All right. So in other words, the investment bank is making money writing this swap based on the fact that they're going to receive interest payments. The frequency of these payments will be every 3 months. And they can choose different durations, but this will be every 3 months. And the maturity for this swap is 1 year. So this is the relationship between the hedge fund and the investment bank. Now, some of this might be a little confusing. So let me show you an example of what a payout would look like. So let's say, for instance, that GameStop goes down 10%. So if it goes down 10% on a $100 million position, they're up 10 million, right? The hedge fund is now up 10 million on the swap. In this arrangement, the stock goes down, the hedge fund is up 10 million because they effectively agreed with the investment bank that they're short $100 million of stock. So when the stock goes down 10%, they're up, right? 10%. If the stock goes up 10%, then the hedge fund is down. So with a position purchased on the open market, your P&L is going to adjust in real time as the stock is going up and down, right? And of course, if you were taking a position in the open market, you also would need the capital to take that entire position. But with these swaps, it's a side bet. I call it a side bet because it's an easy way for me to think of it. But it's an OTC derivative agreement. It's a contract. And so in the case where the stock goes down 10%, the hedge fund is up 10 million. But remember, they have to pay out interest. So this is going to be at the end of a 3-month period. End of the 3-month period, stock's down 10%. So they're up 10 million, but they pay 6% interest, which is the benchmark, 5% plus 1% for the year. So that's $6 million of interest that they're paying on $100 million bucks. So 6 million divided by 4 quarters is 1.5 million a quarter. So they have to pay that to the investment bank no matter what. So basically the investment bank owes them 10 million and they owe the investment bank 1.5 million, which means the hedge fund gets a net of $8.5 million from the investment bank to the hedge fund. Now, if the stock goes up 10%, the hedge fund is now down 10 million. They still have $1.5 million of interest they have to pay, which means the net from the hedge fund to the investment bank is 11.5 million. So the hedge fund it loses plus the interest that they have to pay. So you might think, well, the benefits of the hedge fund here seem somewhat clear, I suppose. They get to profit from the directional bias on the stock without putting up capital to invest in the stock, right? So they effectively have a $100 million position without actually having $100 million in the stock. That's amazing. Now, the investment bank most likely has a collateral requirement. So there's some essentially like a margin requirement, but it's not $100 million. So the benefit for the hedge fund is that they can take a really large position in a stock without having to either liquidate their portfolio or borrow money. So in other words, they can use leverage, and it gives the hedge fund control over a much larger amount of shares and money than they would otherwise be able to afford. Additionally, they don't have the requirements, they're not subject to the regulatory reporting requirements if they take a very large percentage stake, because it's not an actual ownership on the market. It's through a derivative. And unlike options trading, which do correspond if you exercise to stock, with these swaps, it's completely disconnected from actually owning outright stock or shorting stock. And additionally, the short positions are not reported towards short interest. So when we've been looking at GameStop and we're saying, well, geez, the short interest is showing 15, 20% right now. That's true. But we also have to recognize that we have no idea how many hedge funds are shorting GameStop through these equity swaps, right? You could look through some of the filings, you could try to figure it out through DTCC, but realistically, people have tried and it's very difficult to tie that down. So the benefits to the hedge fund right here seem pretty clear. It's naturally risky because if the stock goes up a lot, they could lose a lot of money and they need to have the capital to be able to cover their losses. And so the investment bank, it seems like in this scenario, is the one who's really taking on the risk, right? So what are the benefits for the investment bank? Why are they doing this? Well, number one, they get guaranteed interest payments. They could be either fixed or variable, depending on what the terms are. And what they can do is they can turn around and they can hedge that position with the purchase of stock or options. They can do that if they want to. So they can hedge with existing positions if they already have existing positions on the book on their portfolio. And if they do, then for them, this is like free money. They're getting guaranteed interest payments and they have a hedge. So essentially for them, the profit is the delta between the interest payment, which is income that they're getting guaranteed, and the cost to hedge, which is essentially insurance, right? So if they hedge with options, for instance, or they hedge with stock, they're hedging their position. But either way, they're getting the benefit of the interest. So even if they hedge the whole position with stock, their only risk at that point is, well, the biggest risk is counterparty risk. The biggest risk for them is the hedge fund goes under. So they have to carefully vet the hedge funds that they offer these swaps to, but that's really their biggest risk. So they're in a position where they have so much money, they could afford to buy the underlying asset if they want to for their hedge, or they could use options to hedge. So they can hedge their position, right? So for them, this is where the investment banks, it's a win-win. All they have to do is make sure that the hedge fund that they're selling the swap to is not at risk of defaulting. But here's something that I find really interesting. So with these equity swaps, a lot of these swaps, as we look at our term sheet here, or just to give you kind of this basic idea, a lot of these are going to be based around a very specific price. And they're based on the frequency of the when they make the payouts. So if the payouts are every month, or they're every 3 months, or they're once a year, around the time that we get to a payout period, there's going to be a little bit of a battle. The hedge fund wants to see the stock above or below a certain level, and the investment bank is going to want the exact opposite. So now they're playing a little bit of a tug of war. And what's funny here is the tug of war is over the OTC equity swap and the amount of money it's going to change hands. But they're fighting over the actual market change, the actual market price. And so I'm going to jump forward here to this slide where we can see this is a view of actual orders in the market. And when you view the market like this, what you can see is that you have these sort of tranches of orders, right, in these very specific spots. And this is where we have a battle. We're having a battle between the buyers and the sellers. And in this case, the sellers are keeping the price below these key levels because these are sell orders, and so they're creating resistance. So whether a fund has a large options position, or an equity swap, or a stock position, there's an incentive for the price of the stock to move up or down as payout dates approach. And they will defend the price to keep it where they want it. And this often creates a battle around certain prices as option expirations approach. Quadruple witching, for instance, right? So when we have quad witching, which is when 4 different option terms dates expire on the same day, you have a huge battle that's occurring with these stocks. And so if you're a retail trader, just, easy-go-lucky, looking for a couple of trades, and you don't realize you're trading on a quad witching day, you're going to be subject to a ridiculous tug of war that the whales are having that you want no part in, because they're going to just chew you up and spit you out. You're going to get chopped up in that price action. Anything you think is going to happen is probably not going to happen. And so what's a way to avoid this? Pay attention to the options that a stock has. If a stock has options and it has a lot of open interest and a lot of volume in the options chain, then there's going to be a bigger battle between these areas. And also pay attention to the level of institutional ownership that a stock has. When a stock has higher levels of institutional ownership, this is also when those big guns come out and it becomes a bigger battle. This is what I've seen in all of my years of trading. So I've learned to leave those types of stocks alone. Now, if you want to hear from a former hedge fund manager, I thought this was pretty interesting. This is Jim Cramer from 2006. This is an interview he did on The Street. In this interview, he talked about moving the markets. He said, when I was positioned short at my hedge fund, so I'm reading his quote, I was positioned short, meaning I needed it down. I would create a level of activity beforehand that would drive the futures. It doesn't take much money. Similarly, if I were long and I wanted to make things a little bit rosier, I would go in and I would take a bunch of stocks and I would make sure that they are higher, right? So that makes sense. You want things to look rosier. You go in, you buy a bunch of stocks up, you bid them up, they moves it higher. Commit maybe $5 million in capital to do it, and I could affect it. But it's a fun game and it's a lucrative game. and you can move it up and then you can fade it, and that often creates a very negative field. And I would encourage anyone who's in the hedge fund game to do it because it's legal and it's a very quick way to make money and it's very satisfying. And by the way, no one else in the world would ever admit that, but I don't care. This is Jim Cramer on the street in 2006. Now, a lot of people have debated the ethics of this practice, but what we know is that the motivation for a lot of these firms is to make money in the market. So there's the black and white, what you can do, what you can't do. And even in the black and white areas, a lot of these firms, as we know from naked short selling, choose to make money over following the letter of the law there. One thing that Jim Cramer talked about was the practice of the hit and offer. He said, I used to do what was called, he said, if I wanted to go higher, I would take and bid. And if I wanted to go lower, I'd hit and offer, hit and offer, hit and offer. It'd be fabulous because it would beleaguer all the moron longs. And this is painful to read because I'm a long and I feel like maybe I'm the moron. But the way this works is that you would hit the bid, so sell on the bid, and then throw a huge order on the offer like this one here, 27,000 share order. And then you'd hit the bid again and put another big offer here and move it down a few cents. And you'd keep doing that. You'd hit and bid, hit and offer, hit and offer, hit and offer. And by doing that, essentially what you're doing is you're walking the price down. And so this is what was sort of referred to during the GameStop period as short walls. So we see it a lot when we look at the market depth like this. We'll see all of a sudden the price will drop, and then you've got a big seller that comes right up. The price drops, a big seller comes right up. Or sometimes you'll see the price moving up, and a big buyer's propping it up. It moves up, and it's like they're stair-stepping the price up and down with their orders. So these are the things that happen in the institutional world. So I'm not in the institutional world. I'm a retail trader. So, I've done relatively well, modestly well as a retail trader. I'm proud of the success I've had, but let's get real. I'm a baby fish when it comes to these big whales. So I try to steer clear of the institutional traders. I try to steer clear of the stocks that they're trading. I just want to leave them alone. I don't want to be trading those stocks because that's where we're going to have this big tug of war. So it's like when you have these big, huge equity swaps that are a kind of side bet deal on what happens to the price of the stock, then suddenly these firms could take $5 million, $10 million to push the price up and down. So it better suits their big swap that they have on the side. And these are things that we just don't know. So a lot of it is speculation. We know without a doubt that there's a big battle that occurs around certain prices when it comes to options expiration. But the equity swap expirations, or when they mature, or when they potentially renew and roll over to the next year, to the next cycle, or the frequency of when they have their payouts, these are more obscure. So you may not be aware of them, but then you're trading a stock and you're seeing this major tug of war and this major battle. And it's like, what is happening behind the scenes? And these are only sort of little bits of us sort of pulling back the curtain and seeing like a little bit, but we really don't know what goes on back there. And to be honest, I'm not sure how many people do. The financial system is incredibly layered and complex. And there's no doubt that there's a tremendous amount of regulation, but a lot of that regulation has been created to kind of close up little loopholes. But, it's like these big institutional deep pocket investors find a new way to kind of get what they're looking for. So I hope this has been an informative episode when it comes to how equity swaps work. To the extent that you're a meme trader, again, I think that is sort of irrelevant to gaining value from understanding how these work in the market. And the biggest takeaway for me is being really cautious when it comes to trying to actively trade institutional stocks with high percentage of institutional ownership. Now, if you're going to buy and sell, buy and hold, you're going to buy and hold an Nvidia, an Apple, or a Tesla, then, all this stuff is going on in the background. It doesn't really matter because you're a long-term investor. But if you're trying to actively trade the price action, man, you're going to get chopped up. So you got to be really careful. I hope you found this episode interesting. If you do, hit that thumbs up. I hope you subscribe to the channel, and I'll see you for the next episode real soon. And hey, if you want to learn a little bit more about my stock selection criteria, I will put a link as pinned in the top of the comments and in the description where you can download my stock selection PDF so you can get a better sense of the type of stocks I do want to trade every single day. Thanks as always for tuning in. Remind you, trading is risky. My results aren't typical. So manage your risk, take it slow, and I'll see you here for the next episode real soon.